You know what's fascinating? While most people are scrolling through their phones, completely oblivious, something extraordinary is happening in the gold market right now. And I'm not talking about some minor price fluctuation. I'm talking about a fundamental shift that's going to change everything about how we think about money and wealth preservation. Let me paint you a picture. Right now, as we speak, central banks around the world are buying gold at a pace we haven't seen in modern history. We're talking about 53 tons purchased in just 1 month. That's not a typo. 53 tons. And here's the kicker. That represents a 36% increase from the previous month. These aren't amateur investors making emotional decisions. These are the most sophisticated financial institutions on the planet, the ones with access to information you and I will never see, and they're scrambling to accumulate as much physical gold as they possibly can. Now, you might be thinking, okay, so what? Central banks buy gold all the time. And you'd be right. But here's what's different. Between early 2000s and the early 2020s, central banks were buying an average of 17 tons per month. 17 tons. Now we're seeing numbers that are triple that amount, and it's not slowing down. It's accelerating. Let me tell you a story that'll help you understand what's really happening here. Back in the early 70s, there was a moment that changed everything. The United States was hemorrhaging gold. Foreign governments were lining up at the Treasury's door, converting their dollars into gold at the official rate of $35 per ounce. The vaults were being drained, and on a summer weekend, President Nixon made a decision that would reshape the entire global financial system. He closed the gold window. Just like that, the dollar's link to gold was severed. What happened next? Gold went from $35 an ounce to over $800 within a decade. That's not a 20% gain or even a 100% gain. That's a 2,000+% increase. People who understood what was happening and positioned themselves accordingly didn't just preserve their wealth, they multiplied it beyond their wildest dreams. Now I want you to pay very close attention to what I'm about to tell you, because this is where it gets really interesting. We're seeing patterns emerge today that are eerily similar to that period, but with one crucial difference: the scale is exponentially larger. Think about what's happening right now in the global economy. We've got nations actively working to reduce their dependence on the dollar. The BRICS nations, Brazil, Russia, India, China, and South Africa, aren't just talking about alternatives anymore. They're building them. They're creating payment systems that bypass the dollar entirely. They're settling trade in their own currencies. And most importantly, they're backing these moves with massive gold purchases. China's been particularly aggressive. While they officially report their gold reserves, analysts who track physical flows believe the real numbers are significantly higher. Why would they underreport? Because if the world knew exactly how much gold China was accumulating, it would trigger a buying panic that would send prices through the roof before they finished building their position. It's the same strategy you'd use if you were trying to buy a large position in any asset. You do it quietly, methodically, without tipping your hand. But here's where it gets even more intriguing. Look at what's happening in the physical gold market versus the paper gold market. The COMEX, the major exchange where gold futures are traded, has a fascinating dynamic. For every ounce of physical gold in their vaults, there are multiple claims on that same ounce through paper contracts. It's like a game of musical chairs, except instead of chairs, it's actual gold bars, and instead of music stopping, it's going to be a delivery demand that can't be met. The London Bullion Market Association, the LBMA, is seeing similar stress. These are the two major hubs for gold trading globally, and both are showing signs of strain between paper promises and physical reality. When you buy a gold ETF or a futures contract, you're buying a promise. When central banks buy gold, they're taking physical delivery. They're loading it onto planes and flying it to their vaults. That's a fundamentally different transaction. Let me give you a specific example of how this plays out. A few years back, there was a situation where a major bank had sold gold futures contracts, essentially promises to deliver gold at a future date. When those contracts came due, and the buyers wanted physical delivery, instead of just rolling the contracts forward, there was a scramble. The bank had to go into the physical market and actually buy the gold they'd promised. The price spiked. That was a relatively small incident. Now imagine that happening on a massive scale. Here's something most people don't understand about gold production. We're not finding new major gold deposits like we used to. The easy gold has been mined. The remaining deposits are deeper, lower grade, and more expensive to extract. Mining companies are spending more to produce less. Meanwhile, demand is surging. It's basic economics. When supply is constrained and demand is increasing, prices have to rise. It's not a matter of if, it's a matter of when and by how much. Now let's talk about something that affects you directly. Inflation. Not the official numbers they report, but the real inflation you experience when you go to the grocery store, when you pay your rent or mortgage, when you fill up your gas tank. Your dollars are buying less and less. That's not going to change. In fact, with the amount of currency creation we've seen, it's only going to accelerate. Gold doesn't care about monetary policy. It doesn't care about interest rate decisions. It doesn't care about political promises. Gold is simply a store of value that's been recognized for thousands of years. When currencies lose purchasing power, gold maintains it. That's not theory. That's historical fact demonstrated across every civilization that's ever existed. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I've put together a comprehensive guide on how gold IRAs actually work. It's in the description below. It covers the mechanics of getting physical gold into your retirement account without triggering tax penalties, the custodian requirements, the storage options, all of it. If that's relevant to your situation, it's worth checking out. No pressure, just information if you need it. Anyway, back to what's happening in the market right now. Let's talk about the technical picture, because this is where things get really compelling. Gold recently broke through the $4,000 level. That's not just a round number. That's a psychological barrier that, once broken, opens up significantly higher targets. Technical analysts are looking at charts and seeing patterns that suggest we're in the early stages of a major bull run, not the end of one. But here's what's more important than the charts: the fundamental drivers behind this move. We've got geopolitical tensions at levels we haven't seen in decades. We've got currency debasement happening globally. We've got central banks that have lost credibility with their inflation predictions. We've got a generation of investors who've never experienced a real gold bull market and are just starting to wake up to what's possible. Think about what happened in the late 70s and early 80s. Gold went from around $100 to over $800. People who bought at $200 thought they'd missed the move. Then it went to $400, then $600, then $800. At each level, there were people saying it was too late, that the easy money had been made. They were wrong. The people who understood the fundamentals and stayed positioned made fortunes. Here's a story that illustrates this perfectly. There was an investor, let's call him Robert, who started buying gold in the mid-70s when it was around $150 an ounce. His friends thought he was crazy. Gold doesn't pay dividends, they said. It just sits there, they said. You're missing out on the stock market, they said. Robert didn't care. He understood that the monetary system was broken, that the dollar was being debased, and that gold was the ultimate insurance policy. By the time gold hit $800, Robert's position had grown fivefold. But here's the interesting part. He didn't sell. He understood that the fundamentals that drove gold higher were still in place. He held through the correction, through the bear market of the 80s and 90s, and when gold started its next major bull run in the 2000s, going from around $250 to over $1,900, his patience was rewarded beyond measure. Now, I'm not saying you should hold forever regardless of circumstances. I'm saying that understanding the fundamental drivers is more important than trying to time every wiggle in the price. And right now, those fundamental drivers are stronger than they've been in decades. Let's talk about what's happening with industrial demand. Gold isn't just a monetary metal. It's used in electronics, in medical devices, in aerospace applications. As technology advances, industrial demand for gold is increasing. This creates a floor under the price that didn't exist in previous bull markets. You've got monetary demand from investors and central banks, plus industrial demand from manufacturers. That's a powerful combination. Here's something else that's fascinating. The demographics of gold buyers are changing. Traditionally, gold has been popular in Asia, particularly in India and China, where it's culturally significant. But now we're seeing younger Western investors, people who grew up in the digital age, starting to allocate to gold. They're seeing the same monetary instability their grandparents saw in the 70s, and they're responding the same way, by seeking the safety of physical assets. The cryptocurrency crowd is particularly interesting. Many of them started with Bitcoin and other digital assets, attracted by the idea of money outside the traditional system. But as they've learned more about monetary history, many are adding gold to their portfolios. They're realizing that gold has been the ultimate form of money for thousands of years, and while crypto is interesting, gold has a track record that's unmatched. Let me tell you about the supply side of this equation, because this is crucial. Gold mining is a long-cycle business. From the time you discover a deposit to the time you're actually producing gold, you're looking at a decade or more. That means the supply response to higher prices is very slow. Even if gold goes to $5,000 or $6,000 an ounce, we're not going to see a flood of new supply hitting the market anytime soon. The mines that are going to be producing 5 years from now are already being developed. The supply is essentially fixed in the near term. Meanwhile, demand is accelerating. Central banks are buying, investors are buying, industrial users are buying. And here's the kicker. A lot of the gold that's been accumulated over the years is in strong hands. It's in central bank vaults. It's in the hands of wealthy families who view it as generational wealth. It's not coming back to market at these prices. This creates a situation where even modest increases in demand can have outsized impacts on price. Now, let's talk about what happens when the general public catches on. Right now, gold ownership among the general population is relatively low. Most people have their wealth in stocks, bonds, real estate, maybe some cash. Very few have significant gold positions. But when the narrative shifts, when gold starts making headlines, when your neighbor mentions they bought some, that's when things get really interesting. There's a phenomenon in markets called FOMO, fear of missing out. When an asset starts moving and people see others making money, they want in. With gold, this is amplified because it's not just about making money. It's about protecting what you have. It's about security. It's about not being left behind when the monetary system shifts. That emotional component can drive buying that's far more intense than what you see in other markets. Think about what happened in 2011 when gold briefly touched $1,900. There were lines at coin shops. Premiums on physical gold exploded. You couldn't find American Eagles or Canadian maple leafs at any reasonable price. The mints couldn't keep up with demand, and that was with gold at $1,900. Now we're past $4,000 and most people still aren't paying attention. When they do, when that switch flips, the scramble for physical metal is going to be unlike anything we've seen before. Here's another angle to consider: the role of gold in the banking system. Banks hold gold as a Tier 1 asset. It's considered the highest quality collateral. As the banking system faces stress, as we see more bank failures or near failures, the value of that collateral becomes increasingly important. Banks that are well capitalized with gold are in a fundamentally different position than banks that aren't. This creates institutional demand that's separate from investment demand or central bank demand. Let's talk about the geopolitical dimension for a moment, because this is absolutely critical to understanding where we're headed. The dollar's role as the global reserve currency has given the United States enormous advantages. We can run deficits that other countries can't. We can impose sanctions that have real teeth. We can essentially export our inflation to the rest of the world. But that system is built on trust and acceptance. When that trust erodes, when countries start looking for alternatives, gold becomes the obvious choice. You can't sanction gold. You can't freeze gold accounts. You can't print more gold. It's neutral. It's no one's liability. It's the ultimate form of money that exists outside any single country's control. For nations that are worried about dollar dominance, about potential sanctions, about the stability of the Western financial system, gold is the answer. And they're acting on that realization in a big way. There's a historical parallel here that's worth exploring. In the late 60s, France, under President de Gaulle, started converting their dollar reserves into gold. They sent warships to New York to pick up the gold and bring it back to France. They understood that the dollar was overvalued relative to gold, and they were taking advantage of that arbitrage while they could. Other countries started following suit. That's what ultimately forced Nixon's hand in severing the gold-dollar link. Today, we're seeing a similar dynamic, but it's more subtle. Countries aren't sending warships. They're quietly accumulating gold through regular purchases, through mining production that stays in country, through bilateral trade deals that involve gold. The effect is the same, a gradual shift away from dollar dependence toward gold-backed stability. Now, here's where this gets personal for you. Whether you're in your 30s just starting to build wealth, in your 50s with retirement on the horizon, or already retired and trying to preserve what you've built, this matters. The purchasing power of your savings is being eroded. The promises made by the monetary system are increasingly questionable. The safety nets you thought existed are looking more fragile by the day. Gold isn't a get-rich-quick scheme. It's not going to double overnight. But it's the one asset that's maintained its purchasing power across centuries, across empires, across every monetary experiment that's ever been tried. An ounce of gold bought the same amount of goods 2,000 years ago as it does today. Can you say that about any currency? Can you say that about any government promise? The window of opportunity to acquire gold at what will, in hindsight, be considered cheap prices is closing. Not because I say so, but because the fundamentals demand it. The supply-demand imbalance is real. The monetary instability is real. The geopolitical shifts are real. These aren't theories or predictions. These are observable facts playing out in real time. Think about the people who bought gold at $300 and thought they'd missed the move when it was at $400, or at $800, or at $1,500. Each of those levels seemed high at the time. Each of those levels now looks like an incredible opportunity in retrospect. The question you need to ask yourself is, will $4,000 look like an incredible opportunity 5 years from now? 10 years from now? Based on everything we're seeing, the central bank buying, the supply constraints, the monetary instability, the geopolitical realignment, the answer is almost certainly yes. This isn't the end of the gold bull market. This is the beginning. The easy gains might be behind us, but the substantial gains are still ahead. Here's the thing about major market moves. They don't happen in straight lines. There will be pullbacks, there will be corrections, there will be moments when it feels like you made a mistake. But if you understand the fundamentals, if you understand why you own gold, those moments become opportunities to add to your position, not reasons to panic and sell. The wealthy understand this. The institutions understand this. The central banks understand this. They're not buying gold because they think it's going to go up 10%. They're buying gold because they understand that the entire monetary system is in transition, and gold is the anchor that will allow them to navigate that transition successfully. You have a choice to make. You can wait for more confirmation, for more proof, for the move to become so obvious that everyone sees it. But by then, the price will be significantly higher, and the opportunity to position yourself advantageously will have passed. Or you can act now, while there's still time, while gold is still available at prices that will seem absurdly cheap in the not-too-distant future. This isn't about timing the perfect entry point. This isn't about catching the exact bottom. This is about recognizing a major shift in the financial landscape and positioning yourself accordingly. The time to buy cheap gold is ending, not because of hype, not because of speculation, but because the fundamental forces driving this market are undeniable and accelerating. The question isn't whether gold is going higher. The question is whether you'll be positioned to benefit when it does. The central banks have made their decision. The institutions have made their decision. The smart money has made their decision. Now it's your turn.